Well, thanks, Stephen. Good morning. Bonjour tout le monde. Carolyn and I are very happy to be here to answer your questions about today's interest rate announcement and our latest monetary policy report. Now, let me begin with just a few remarks around the issues that were most important to the Governing Council's deliberations. Voyons tout d'abord la conjoncture mondiale. La chute des cours du pétrole tenait surtout à la forte croissance de l'offre, mais un recul de la croissance de la demande a aussi joué un rôle. Les prix d'une vaste gamme d'autres produits de base ont continué à descendre cette année, ce qui indique également que l'économie du globe a été plus faible. Dans ce contexte, de nombreuses banques centrales ont assoupli leur politique monétaire cette année, y compris la Banque du Canada. Cet assouplissement généralisé, combiné aux implications favorables de la baisse des prix de l'énergie pour la croissance mondiale, nous porte à conclure que l'économie du globe se raffermira tout au long de l'année. La différence accrue des conditions économiques donne lieu à des politiques monétaires également divergentes, à une volatilité plus grande des taux de change et, au final, à un dollar américain plus fort. Turning to Canada, as we stated in the January MPR, although lower oil prices would have both upside and downside effects on Canada, the net effect would be negative. The negative effects would be immediate and seemed quite certain, whereas the positive effects would be more gradual and less certain. Therefore, we faced a risk that our return to full capacity and stable 2% inflation would be delayed significantly. Accordingly, in January, we took out some insurance against that risk in the form of a 25 basis point reduction in the policy interest rate. Our cut, along with developments in other countries, led to lower rates across our entire yield curve and a lower Canadian dollar. Meanwhile, oil prices stabilized and recovered to levels around our January forecast assumptions. And as we monitored the data, we saw that some of the effects of lower oil prices were already being felt during the fourth quarter of 2014. The updated forecast in today's MPR suggests that the economy saw no growth in the first quarter. I want to emphasize that policy does not hinge on decimal points. We always know that we are dealing with a range of possible outcomes. Interpretation of the recent data is complicated by the slowdown in the U.S. in the same quarter, which no doubt was partly due to severe weather and a port strike in Los Angeles. We also had some unusual weather here ourselves. However, our best judgment is that the data, our best judgment is the weather will improve, but our best judgment is that the data that we've received so far remain consistent with the view that the impact of the oil price shock is proving to be faster than initially expected, not larger. Outside of the energy sector, other areas of the economy appear to be doing well. In particular, the segments of non-energy exports that we have been expecting to lead the recovery have been doing so, and we expect this trend to be buttressed by stronger U.S. growth and the lower Canadian dollar. Our own Business Outlook survey indicates that capacity constraints are beginning to emerge for exporters, which is promising for new investment. And although we still have material slack in our labor market, the market's fundamentals have begun to improve. Even so, companies remain cautious about new investment and hiring intentions. Après avoir soupesé ces diverses forces à l'œuvre au sein de l'économie, nous anticipons que la croissance va rebondir au deuxième trimestre et qu'elle dépassera le niveau tendanciel par la suite. Elle s'établira en moyenne à 1,9% pour l'année. Ce profil de croissance prévu nous ramène sur la bonne voie pour une disparition des capacités excédentaires vers la fin de 2016, lorsque l'inflation s'établira de façon durable à 2%. Nous jugeons que les risques qui pèsent sur cette projection sont à peu près équilibrés, mais nous allons les réévaluer continuellement à mesure que de nouvelles données seront disponibles. Le principal risque tient à l'ampleur et à la durée de l'incidence négative du choc pétrolier, mise en balance avec les forces positives qui s'accumulent dans le secteur des exportations hors énergie. Selon nos prévisions, les effets positifs commenceront à se renforcer au deuxième trimestre et cette situation prévaudra nettement au deuxième semestre de l'année. La réduction du taux directeur en janvier et la dépréciation du dollar canadien contribuent à accélérer la transition. To give just one example, exporting companies with existing contracts denominated in U.S. dollars are seeing an immediate 8% increase in Canadian dollar cash flow and will be able to compete more aggressively for future sales. Inflation, as measured by total CPI today, is running at about 1%, well below our 2% target. Now, this is largely due to the drop in gasoline prices, a temporary effect. But total CPI inflation would be even lower than 1%, in fact, quite close to zero, were it not for exchange rate effects, which are boosting total inflation by 0.6 to 0.7 percentage points, and some additional one-time factors. Core inflation is running at about 2%, but it is also being boosted by exchange rate effects and a couple of other one-time factors. Now, because monetary policy takes up to 2 years to have its full effect on inflation, responding to every fluctuation in prices would be counterproductive. Therefore, we generally look through inflation variations that, in our judgment, will prove temporary. These judgments constitute a very important part of our deliberations. Now, presently, we are looking through the effects of the drop in oil prices, the effects of the recent depreciation of the Canadian dollar, and the one-time effects of fluctuations in meat and telecommunications prices. This is why we refer to underlying inflation, which estimates and excludes what we judge to be temporary factors, and is driven mainly by the changes in the degree of excess capacity in the economy. In our projection, total inflation, core inflation, and underlying inflation all converge on the same level once temporary factors have dissipated. Meanwhile, the issue of financial stability risks remains front and center in our deliberations. These risks are evolving in line with our expectations. The level of household indebtedness, as measured by the debt-to-disposable income ratio, continues to rise. And it's likely to rise further as the decline in gross national income due to the halving of oil prices works its way through the system. On the surface, lower interest rates would be expected to promote more borrowing, which would increase this vulnerability. However, in the near term, lower borrowing rates will actually mitigate this risk by reducing payments for mortgage holders and giving us more economic growth and employment gains. We believe that the best contribution the bank can make to easing financial stability risks through time is to help the economy return to full capacity and stable inflation sooner rather than later. And with that, Carolyn and I will be happy to take your questions.
First question goes to Richard Madden of CTV.
Hi, Governor. Based on this report, is the economy as atrocious as you believed it would be, and I'm hoping you can define what that means in this context.
Well, the data from the first quarter surely will continue to look poor. We don't have that many data from the first quarter yet. It'll be the end of May when we receive the national accounts for the first quarter. So there's a lot of data to come before that. 6 months ago, we believed that in the first quarter we'd be growing at around 2.4%. And today we estimate that we're growing at 0%. And that's a pretty big revision downwards, the direct fallout from the oil price shock. As I said, lots of indicators still to come, so we'll see. We have to monitor them carefully and sift through what they mean about that. The key issue for us is is the oil price shock having a bigger effect or just a faster effect? That is the key thing that we have to assess. And then that assessment is weighed against the positives, which I've talked about, which we can see very clearly. So it's better to focus, I think, on what is ahead. Look for confirmation that the underlying positive forces are acting as we think they are and that they continue to gather momentum. Obviously, our forecast for Q2 cannot be considered a sure thing, and forecasting never is. We have to weigh those things as we go through the next few weeks, and it is our number one risk as forecasters. So stay tuned.
And last week, our finance minister revised Canada's outlook to 2%. Yours is 1.9%. So what's the reason behind the discrepancy?
Well, I don't actually consider that a discrepancy. It's just that when we want to run our models and come up with our judgments, then we add things up. We came to 1.9%. That's, as we say, it's about 2%. And policy does not hinge on these decimal points at all. We think that usually a forecast, even in the near term, has a plus or minus 0.5 percentage points around it, and anything in there is reasonably consistent with what we're looking for, and it's reasonably consistent with our policy trajectory.
Prochaine question, Paul Vieira, Wall Street Journal.
Is it fair to say that it is the Bank of Canada's belief that the negative fallout from the oil shock will be short-lived, given that you're seeing a rebound in Q2 and then pretty solid growth in the second half of this year?
So we know that the initial effects of the oil price shock are virtually immediate. So when you're exporting oil and the price used to be $100 and then suddenly it's around $50, that happens right away. So the income effects, which we've shown GDI, gross domestic income, as a chart in the MPR, those are immediate. And the question then becomes, well, how does it then find its way to the rest of the economy? Our reading on this is that it happened pretty quickly. We saw already evidence in investment and consumption and housing spending in the fourth quarter, which are probably attributed to that shock. And then we had late in the last year and early in the new year, a lot of announcements by companies about what exactly they would do in terms of cutting back investment. So those all plans that seem quite concrete. But when people are laid off, the question is, well, what happens next, and how long does it take? For us, the good news is that we see signs that the underlying labor market health is improving. We still have lots of excess capacity in the labor market, but we don't want to get ahead of ourselves in this story. But a number of indicators suggest that the health is improving, which is usually good it indicates a higher level of optimism in the ability to move jobs and to move around. Carolyn, would you like to elaborate on the labor market side?
Sure, Governor. We tend to look at the labor market in quite a lot of detail, and what that means is we look beyond the unemployment rate to a number of other indicators that give us an idea of underlying health. And while overall there's still a lot of slack left in the labor market, there's some positive signs that we thought important to highlight to give a balanced view on what's happening there. And those come from just the fact that long-term unemployment, which had been hanging up pretty high, has started to edge down. The participation rate of prime age workers that had fallen is starting to recover, and other indicators like involuntary part-time unemployment, things like that are going in the right direction. Now, of course, we still need to factor in that there may be more to come when it comes to the fallout from the oil price decline. But nonetheless, when you have things like job vacancies as a proportion of unemployment moving up, that means that as people become displaced, it will be easier for them to find jobs.
As a follow-up question, I'm wondering if you can add a little more color to this underlying tenet of your outlook, which is that non-energy exports are going to drive growth, starting with robustly in the second, especially robustly in the second half of this year. There's still skepticism given the weakness, recent weakness in the U.S. and weakness globally, especially in China. Why is the Bank of Canada so optimistic about the outlook for non-energy exports? I'm just looking for particulars, color,
Sure.
stuff like that.
Well, there's a good section on that in the MPR, which I'll refer you to, and a good chart which breaks down the non-energy exports lump into the categories we expect. This is based on the analysis last year. We expect to lead the recovery. Those categories expected to lead the recovery are primarily in what I would call in the investment channel, which is what U.S. companies buy, as opposed to what U.S. consumers buy. And so they're investment-related goods, and they were, in general, exchange rates. They displayed exchange rate sensitivity in the past. And so we did that data mining last year and isolated these categories. And so if you look at those key members of that category include aerospace, which is very strong, machinery and equipment, building and packaging materials, metal products, and one which doesn't quite fit that classification is pharmaceuticals. Okay, is a big growth category. So anyway, the non-energy exports that we expect to lead the recovery are on the order of half of the non-energy export category. Energy exports are like a quarter of exports, and then the non-energy exports, half of them are expected to lead the recovery, and the other half do not. And so the easiest way to look at the data, non-export data, is to say we know over the past almost a year we've had some lumpiness both to agriculture exports because of weather effects and transportation interruptions, and we've also got car exports, which are also very lumpy and were affected by weather, et cetera. So for those reasons, if we could take those two categories out, which I think are very important, but just to visualize the recovery we're talking about, it's very clear. And if we look at the export-oriented segment of GDP, it is growing at twice the speed of the overall, the domestic economy, what we call domestic-oriented GDP. So 4-point-something%, over 4% growth in the export-oriented GDP, around 2% for the domestic-oriented GDP. So we're confident that this story is taking place. You can question whether the U.S. recovery will reassert itself. That's a debating point, something worth monitoring. But the fundamentals are very good, and we think we can ascribe to temporary factors what we saw in the first quarter. Our folks are calling it a wobble. So let's look forward. The indicators I think are all there. So. But again, it's a forecast risk, so you're on one. Thank you.
Next question, Greg Quinn, Bloomberg News.
Hello. Can you run through again why there was such a significant increase to the projections for headline inflation in the MPR?
Oh, the main change to inflation in the forecast is because of the depreciation effect. So that. Our estimation of how much inflation is being boosted by depreciation has gone up because, of course, we've had some more depreciation since we did the January MPR, 7 or 8%. So, the two assumptions are, I think, 8% apart. And of course, in our forecast assumption, we just keep the exchange rate constant for the rest of our forecast. So that's pretty close to arithmetic. There's a model-based thing there, but did you want to elaborate on that? Or?
No, it is.
No, okay.
It's really reflecting that.
Yeah, so that's the only thing. The rest is just, as I said in my opening remarks, obviously gasoline prices have knocked total inflation down, as they have in every country. And for us, it would have gone even lower were it not for the exchange rate effect that's feeding through at the bottom. On the order of 0.6 or 0.7 points are being added to total inflation by the exchange rate. Yeah. But, right? So less than that for core, but still important.
I'd like to go to the risks of housing. You mentioned oil prices in Calgary, but high prices in Vancouver and Toronto. We know that consumer debt loads are very high. Yet you're saying in this report again that cutting interest rates helps consumers. Isn't that looked at, if you look at it another way, it sounds like kind of a hair of the dog remedy for a hot housing market. What do you say to that?
Well, we think that we obviously are not dismissing these risks. They're our headline risk in our FSR, and they remain a headline risk for Canada. This is a major vulnerability. We said all last year that the imbalances in the household sector, which is debt plus the housing, those two things together, was a vulnerability, and we had to be wary of any catalysts that would cause it to erupt as an actual risk. And now the oil price shock does give you a bit of a catalyst to certain regions of the country, although on our analysis, probably not a generalized one, but one that nevertheless matters. I think we have to admit that the way monetary policy works is when you cut interest rates, you're imagining somebody taking on some more debt in order to buffer the shock in the economy. Generally, you picture someone who is not already heavily indebted choosing now would be a good time to buy a house, let's say, or to buy a car, whatever they do. And of course, our really important segment is the company sector, who we hope are ready to borrow to make investments. So those credit channels are wide open for that. But for those who already have a mortgage, the proportion who are floating are now immediately saving money. That cash flow is a buffer. And for those who are on fixed, there's sort of a succession of renewal, as you know, and that builds through time. So, that kind of interest rate relief works its way in there and kind of softens the blow, if you like, which is why we took it out as insurance in that channel. Do you want to add something to this?
Well, Greg, you mentioned the housing sector in Toronto and Vancouver, and clearly when we're looking at things, we also look at more areas of Canada than there. And when we look at the housing market overall, we see that overall there have been signs that are continuing to point towards a soft landing. If you look at activity, so starts and resales, abstracting from the latest data point, be wary of that. That overall they've been slowing. In fact, look quite consistent with a more balanced market in most areas. I mean, clearly, house prices have been decelerating again, not focusing on latest data points, but as a trend. Now, of course, there are some areas where it's still rather robust, Toronto and Vancouver. But again, we set monetary policy to achieve our inflation target, and it's certainly not the first line of defense against that kind of situation. The government has taken out a number of very constructive measures in that regard, and certainly that would be the first line of defense after households just taking the right decisions financially.
So to cap that off, for us the most important thing is we get the economy back to its full capacity, that the jobs get created, the incomes that are generated, and that in effect gives us the support for that housing sector and that debt load from beneath. Interest rates certainly aren't the tool to try to manipulate that risk.
Prochaine question, c'est pour Rudy Lecoeur de la presse.
Bonjour.
Bonjour, Rudy.
Dans le rapport sur la politique monétaire, vous parlez d'un retour au plein potentiel fin 2016. Par contre, le taux directeur est à 0,75 %. Le taux neutre, vous rappelez que c'est entre 3 et 4 %. Il reste 13 réunions d'ici de date de fixation du taux directeur d'ici la fin de 2016. Ça veut dire qu'avec une augmentation de 25 centièmes à chacun des 13 prochaines réunions, on serait à 3,5 %, donc en plein milieu de votre fourchette. Ma question est double. Est-ce que ça signifie que vous risquez d'être en retard de la courbe, ce qui est très dangereux pour une banque centrale, ou ça signifie finalement que le taux neutre est beaucoup plus bas que votre estimé actuel?
La réponse honnête, et on ne sait pas. Mais en termes de le taux neutre, on estime que c'est autour de entre 3 et 4 mais le taux pour la politique monétaire dépend au choc qui touche l'économie en ce moment. Et pour le moment, on peut voir que même avec un taux directeur très bas, on a un taux de croissance de peut-être 2% pour cette année. C'est évident qu'il y a des vents contraires qui poussent l'économie. Et ça dépend de cette situation dans 2 ans. Si la situation continue d'avoir les vents contraires, on pourrait avoir un taux directeur qui est plus bas que le taux neutre. En même temps, on pourrait avoir l'inverse. Si, par exemple, notre troisième choc dans l'MPR se réalise, c'est par exemple si l'économie américaine donne des chiffres beaucoup plus accélérés que dans notre prévision. On aura une vente qui nous pousse, c'est pas un contraire. Alors, on prend chaque décision à la fois, juste une fois chacune, et on va simplement analyser les données quand il arrive. C'est notre situation.
Mais en sous-question, l'inflation de base, l'inflation de référence est déjà à 2 et
ça.
vous prévoyez qu'elle va rester à 2
Oui.
Est-ce qu'il n'y a pas un risque, justement, que si on soit avec un taux directeur trop faible, que l'inflation augmente plus rapidement que ce que vous prévoyez?
Mais en même temps, nous avons une convergence du taux de croissance de l'économie et le taux de croissance potentiel en même temps, en 2017. Je pense que c'est le deuxième trimestre de 2017. Alors, avec cette convergence, il n'y a pas de pression sur l'inflation, mais si on identifie les chocs qui vont toucher cela et poussent l'économie dans une situation de demande-accès, ça, c'est une autre question. Et pour le moment, certainement, il n'y a pas quelque chose comme ça dans notre prévision.
Next question, Catherine Cullen of CBC.
Sir, you mentioned, well, your report says rather clearly that you feel that the shock is happening faster, but that it's not bigger. But a few moments ago, you said the key will be to see whether it's faster or bigger. So I just wonder, can you clarify how confident you are that things are going to pick up in a few months?
Well, these are economic forecasts. There's a lot of judgment that goes into these things, and as you can tell, there's no single data point that's going to tell us the truth. You look at all the data points and assemble the full picture. And as I mentioned, we were a little bit surprised to see as much effect in the fourth quarter. We thought it would take until the first quarter to start showing up. So that's one clue that companies were pretty quickly reacting to these declines in the oil price. I guess, so you contrast that to perhaps the wait and see kind of approach that you might have envisioned when you're making a forecast. So there's that. The second thing that makes it hard to disentangle is that you can't, when you look at a report, let's say the GDP monthly report from January, you can't go there and say, oh, this is the oil sector effect. When an oil company says, well, I was planning to put 4 rigs into this project this year, and I'm canceling all 4 of those. Well, that for him as a cut his investment spending, and he may lay off some people. But down the chain, or up the chain, I should say, is a manufacturing firm that builds rigs. And so what you see is negatives in manufacturing, which some people think, well, wait, aren't you expecting the manufacturing sector to be the source of growth? And so if we look at the manufacturing as a whole, we are seeing, as I said, encouraging signs. And it is growing at something like 4% compared to a year ago. And it's correlated with that the export story that I told earlier. So those positive signs are there. And right now you can't see them because the oil price shock has overwhelmed them. So our belief is that as the oil price adjustment finishes, which could be, now or during the second quarter, what happens then is the positives of the other things start to show up more as the dominant story in our data. So that is a difficult thing to read. You're looking at two things that are absolutely experiencing two different things. And between them is a bunch of consumers, some who have been laid off, trying to find work, maybe thinking of moving, and all those kinds of things. That it is a big piece of detective work, and the forecasters will be working very hard on that for some time. It's going to suddenly be over as an intellectual matter.
But if the question is how confident are you, it sounds like what you're saying.
I'm very confident in our judgment as we've got it today. But these data never go in a straight line. A few days go by and you get another data point and you think, gee, why is that? Because that doesn't seem to fit with my expectation. Well, then if you get a good explanation, then you're good. Your forecast is intact. If you can't explain it, then you start to worry that you've got something a bit wrong in your forecast. And that's kind of the nature of the beast. That over the next 3 months, that's what they do, reaching to the next MPR. And we'll have an update midway through that.
Can I just ask, you've seen some numbers now. Is this atrocious?
Well, the numbers, as I said in the first question, we don't even have close to all the numbers from the first quarter. I expect the data flow from the first quarter to look quite negative. So witness today's manufacturer's report. So I haven't had time to disentangle all that. It was obviously a negative report and a negative revision from the previous month. That's the kind of negative data point we're expecting to see in various ways over these next couple of months as we complete the picture, the first quarter. But all that then would add up to perhaps our monitored number, which is around 0% growth for the quarter. So it's important that people understand that we're expecting to see those negative numbers. That's where the zero comes from. And then what we're expecting is that these positives, which are still there, they're not gone away, but they're just not big enough yet to counteract those things. They're big enough in the second quarter to show up as the main thing. And in effect, oil shock and the positives have traded places. And by the middle of the year, we should be seeing only the good stuff.
Next question, Andy Blatchford to the Canadian Press.
Governor, how would knowing that a federal budget is always going to be balanced affect your approach to decisions?
I don't think it would. We take our fiscal assumptions directly from whatever is announced, and so normally if there were if you have a fiscal plan, like the budget will have a multi-year fiscal plan in it, and it's conditional on an economic forecast. And so with that, we're able to figure out for our own models what the fiscal line should show. And so that's what we put in. And I think you can see there's a table with the breakdown of GDP and the MPR, and it shows that government, despite everything that, it's a very complicated thing, obviously, but it all adds up to something like 0.2 percentage points positive contribution to GDP growth through the next couple of years in our forecast. And that's the result of doing all of that and inserting it in our model. Having that framework around it just means that the way the budget would be presented would respect that. So we would still take the underlying fiscal assumptions directly from it. Wouldn't change how we think.
I was wondering what you thought of the swacking of the $5 bills phenomenon, and would you welcome measures to protect Canadian banknotes from being defaced like coins are?
Well, even though I'm a big Star Trek fan, as you know, I wouldn't encourage people to deface the currency, but Carolyn is responsible for currency affairs, so why don't you, and she's not as much of a Star Trek fan, so she's more objective.
I won't comment on whether I'm a Star Trek fan or not, but writing on banknotes is not illegal. However, we don't recommend it for a couple of reasons. It reduces the lifespan of the currency. We've worked pretty hard to have notes that last a long time, that can be recycled, and in that way we can be responsible both for the money we spend to produce them, but also ecologically. And so for that reason it doesn't seem to make sense. Also, it may actually interfere with the security features, and so you wouldn't be able to possibly have your note accepted as a medium of exchange. And as we've seen, banknotes are a source of national pride, and for that reason it's inappropriate to write on them.
Would you be open to seeing, would you welcome measures to protect the banknotes? Like you see?
I think the current system works fine the way it is. We see our banknotes lasting, we thought they would last 2.5 times more than longer than the paper notes. We see that that's true and even more, and I think we've got a very good set of banknotes, and that our system's working well.
Thank you. Next question, Mike D'Souza from Reuters.
Governor, in terms of the forecast or the projections that you have for the anticipated recovery that you're expecting, does it rule out the need for additional insurance? And you spoke about headwinds also previously. At what level would those headwinds have to get to for you to consider in the next MPR any kind of additional insurance?
Well, based on our judgments that we have today and the data we have today, what this projection shows is that we get back to full capacity sometime around the end of 2016, and that is the main ingredient to ensuring that inflation stays steady at 2%. So that on its own suggests that given what we know today, we have a balanced risk forecast, and therefore the inflation outlook has got risks on both sides, but we believe that they're balanced, and so we have the right amount of insurance. So having taken out that insurance in January, we're glad it's turned out this way. Okay, so that's point number one. But that's today, and what we have to do is watch the data, as we've been discussing before. And for us, the key forecaster risk is the fallout from the oil price shock. Is it possible that what we're seeing today, which looks faster, is it because it's bigger? If it's the same speed as we thought originally and it just turns out to be bigger, well, that's a different matter, obviously. And let's walk through that scenario. If it were bigger, that would mean that the output gap, which already increased, so there's more downward pressure on inflation today than there was a few months ago because there's more excess capacity. That could widen a little further, and that would mean that our projected path of getting the economy back to full capacity with stable inflation would be pushed out sometime into 2017. And so then that would be a case for considering changing monetary policy. If we monitor the data and the reverse became true and the U.S. recovery is even smarter than we thought, and we get feeling more confident, then of course the reverse could be true. So what I've just described is the way policy always is, which is data dependent. So the data will tell us, and we'll reach the judgments about things that are perhaps temporary or not temporary. We have to make those judgments, and we're gonna see you in 3 months' time with a new story. But in the meantime, we don't take the time off. We're working at it every single week as that narrative evolves, supported by the data or rejected by the data. And no single data point knocks you off it usually. It's just an accumulation because there's always, as I said, they never go in a straight line. So bottom line is that I simply can't answer that question today because it depends on how things turn out. But based on what we see and our best judgment combined with our models, I will say this, that we're very conscientiously being conservative. People ask about the outlook for exports. Well, the export sector hasn't behaved normally for the last few years, so we're not assuming it suddenly is behaving normally. Okay, just because the exchange rate went lower, the response in our models would suggest something. We say, well, not sure if that's going to work out quite because this is different, this is different. So a lot of judgment in that. Similarly for consumption, in the first quarter, consumption was weak. Is it temporary because of weather? Did people just stay home because of the snow? Or is it because they're changing their minds about something? Or have they decided to spend the extra money that they're saving on gasoline, or have they decided to save most of it? We don't know the answers to all those things yet, and that's, again, something we have to judge as the data unfold. So I've answered it long enough. You get the idea.
Yeah, in terms of the decision that I think you'll have in September, are there any challenges or sensitivities that you see having that announcement when there's also going to be an election campaign going on? Does this affect in terms of the way the bank is going to approach that?
No, absolutely not. This is well, one of the reasons why the bank is independent. It's because we have a job to do, and we can go about that job independent of what's going on with the government. So now, for us, the data will do the speaking, and then we'll keep you informed as they arise. So anyway, if the forecast is true, well, things will look, improved as we go through the year. I think that that recovery in the second quarter is the key analytical question that we face, and we'll be watching it very closely.
Sir, yes?
I just have one question about the labor market, and you had touched on it a little bit earlier. It's given that the loss of jobs hasn't really shown up in employment statistics based on the oil price shock. How confident are you of the improvements that you've seen in some of the indicators, and how do you see that playing out in the next little while?
So, as I think I said before, we don't want to get ahead of ourselves here. There's still lots of excess capacity in the economy as judged by labor market data. What we're referring to there, or acknowledging there, is that there's been some noticeable underlying improvement in the health or how the market is functioning, and that speaks to a perhaps more dynamic market. And you want to touch on any of the specifics that you like?
Well, I'll just go back to what I said before, just in terms of the underlying movements there, in terms of long-term unemployment, the involuntary part-time, the return of some people who were on the sidelines to participating in the labor force. These are all signs of some healing in the labor market that we've been looking for. Now, of course, they're early signs. There's still a long way to go. We just thought that it was important to mention it because that overall labor market environment is really important when you're going through a transition like we are now. And so it's nice to see that there is some underneath, some positive things going on.
I think the thing to bear in mind is that we only see the tip of the iceberg, really, of what's going on in the labor market with those statistics. So in gross terms, there's much more of job losses and job gains underneath the surface, right? And so it's that sense of churn and better matching, which is what I mean when it's a sign of health. So if the participation rate is rising, people are getting a little more optimistic because they heard so-and-so got a job or so-and-so got a job. So they start stepping up back into the workforce. And so those are the precursors to a true improvement in the labor market. Without them, you wonder when it's ever going to happen. And so that just means that it may be that someone who may lose their job because they work for a supplier of oil rigs in manufacturing may have a higher chance of getting another job now in a different sector than they would a year ago or something when those underlying health didn't seem as good. So that's what's at work in that statement.
I think we have time for one more question from Richard Bannon at CTV.
So just somewhat unrelated, this morning the president of the European Central Bank was attacked by a protester. I'm wondering what you may have heard about it, and if you're sensing, as you travel across the country, wherever you go, a certain uneasiness or frustration by the general public with the economy continuing to remain fairly weak.
Well, yeah, I did hear that there was a protester at Mario's press conference, but I mean, I don't know what that means. I mean, really. As for here, when we talk to companies, they're in general pretty upbeat. They see the reasons to be looking forward in a positive way. Many of them are referring to the U.S. recovery. That's giving them encouragement. But earlier someone mentioned that China is weak. Well, China data this morning is growing at 7%. That's of course not weak. That's a very strong growth rate for an enormous economy. So extra demand every single day from that economy. So it's not that is at issue. I think it's more about the question in people's minds is it for real and will it last? So will it endure? And it seems like over the last 3 years or so, every time it looked like it might be, something else has come along to kind of knock it back. Some disappointment globally, or disappointment in the U.S., or now the oil price shock. Something. And I think that just part of the environment that we're in. It is like this, and that uncertainty is something that companies will, over time, either learn to manage or find ways around, and just means they need a little more confidence than normal to take that extra step. And I think that confidence is growing in my informal soundings, and therefore so is ours.
Thank you very much.
Thank you. Sorry. Yeah, it's true. It's true. It's a little bit weaker. Yeah. Thanks.